Good morning and welcome to today's session on the economic and housing market update. Thank you, Kevin, for the introduction. I want to give you a broad overview of what's happening in the economy and the housing market and thematically along sort of five main themes. First of all, economic growth was very strong in 2021. However, it slowed down quite a bit and in fact contracted in early 2022, and the prospect of a recession is rising in 23 due to the drags from government spending, monetary policy, and inflation. Second point is that the trajectory of the current inflation expansion has been lopsided with much faster goods spending than services spending. But then over the last year, it's really rotated back much more to services. And this has made sort of analyzing the market a bit harder, and it's made the economy and markets basically more volatile. Third point is that inflation continues to surge, sort of unabated, with the rotation of consumer spending into services, and it's broadening and becoming more persistent and sticky. And so this is a main concern and one of the main reasons why the Federal Reserve continues to hike interest rates. And then the fourth point is that over the last 2 decades, basically up until 2022, lower mortgage rates were capitalized into higher and ever higher home prices, causing the housing market to be much more sensitive to interest rate changes. And the large increase in mortgage rates in 22 has led to the fastest deceleration in home prices in over 4 decades. The fifth point, and is one that's a bit more optimistic, and that is partly due to COVID, heavily due to COVID, there's been a large migration out of coastal expensive areas and into interior markets. And this is a very large arbitrage opportunity for many homers, and it's become a major driver of home prices across markets throughout the country. So let's talk about economic growth. If we take a look at historically the average by decade, in the 1960s, the economy grew at about an average of 4.5%. It decelerated to basically in the low threes in the 70s, 80s, and 1990s, and then it decelerated further to a little bit under 2% during the 2000s, and then in the 2010s it picked up a little bit. The reason that you see this sort of steady decline by the decades are two main reasons. First is population growth. Population growth, literally by decade, has steadily declined since the 1960s. And then also productivity has declined over the last few decades. And these are the two main ways that you can create extra additional growth: more people and the productivity rate of those people who are working. When we take a look at 2020, we had a 2.8% decline due to the pandemic, and then a massive recovery. And the recovery was heavily driven by the stimulus. The government stimulus pumped in about $5 trillion worth of support, economic support, over a short time span, and that's very large. That's about a quarter of the economy. It's about 25% of the economy, and it continues to lead to some economic growth in 22. However, those forces are really fading and beginning to go into reverse here. I've plotted the three biggest swing drivers of growth over the last few years. Number one, government expenditures, which is in the green. Second is durables, consumer durables spending, so spending on cars, appliances, things like that. And then residential investment, the construction market of single family and multifamily, and all those factors boomed during the pandemic. In particular, durable spending, as many Americans were stuck at home. They basically bought more toys and goods. So they bought Pelotons and things like that, and that really drove up consumer spending. And some of that was driven quite a bit by the stimulus. That all went into reverse basically in 22 as the economy really opened back up to in-person consumption, and consumer spending rotated out of goods and into into services. At the same time, the run up in interest rates really put a cramp on durable spending as well, given that many consumers are going to finance things like car purchases. It also has led to a pretty large decline in residential investment. And so all three factors which led to the boom during the pandemic have now shifted in reverse and are causing the economy to rapidly decelerate. The other major factor is inflation. Inflation has increased to the highest rate since the early 1980s. And what we've done here, and particularly if you focus on the chart on the left-hand side, we've hand categorized the hundreds of different categories the Bureau of Labor Statistics tracks for their prices, and we've split them out into what we call frequent, infrequent, and contractual goods and services. An example of the frequent, which is the light blue line, are things like gas prices. They change very frequently, many times intraday. You'll see changes in gas prices at local gas stations in the morning and then again in the afternoon. Infrequent are things like apparel that change, every couple months or every few months as the market conditions shift. And then lastly, your contractual, which is the light green line. These are things like your rents, your phone bill, things like that are kind of a subscription, annual subscription. You can see that the inflation for frequent goods and services has already begun to come down. A lot of this is due to energy prices, which soared and begun to ease. Those same drivers, a lot of its energy, has also led to a decline in infrequent inflation, which is the yellow line. The concern is the contractual inflation, and housing is one of these. So, your rents or your mortgage payments are embedded. And the concern with the green line going up so fast, i.e. contractual inflation, is it's very sticky and it tends not to move very quickly. It's sort of like a giant ocean liner. Once it starts heading in one direction, it keeps going that way for a while. And so as a result of that stickiness of the contractual inflation, inflation has been not only sticky, but many forecasts of inflation have just been completely off. And so here I've plotted the increase in headline, the consumer price index and the core consumer price index. The difference between the two lines are that with the core CPI, we remove the volatile consumer inflation categories such as food and energy. So that tends to be a little bit more stable. And you can see here that the forecast of the headline CPI from April or so of 2021 through October of 2022 have consistently shown a downward pattern, and they've been off the entire time period. So inflation forecasts have been off, and the main reason is that the type of inflation has really become more sticky as it's broadened out from just the goods segment. And you can also see this here when we split out goods and services spending. If you can focus on the left-hand side here, I've plotted an index of goods consumption in the black line and services consumption. You can see services consumption took a bigger hit during the pandemic, mainly because many services are consumed in person. Goods took an initial hit and then had a really fast rebound. And you can see that it increased 20% in the span of a year, which is amazing, given that in any particular year prior to the pandemic, it generally increased 3 to 4%. Services spending took a much longer to recover. What's interesting is that the goods are only about 20% of the U.S. economy. Services are about 80%. So services are the sort of the 800-pound gorilla that's been really picking up lately and driving inflation forward. And you can see on the right side, I've plotted the inflation for those same two segments, but we've removed food and energy to stabilize the inflation metrics for goods and services. And you can see that what's really interesting about goods inflation is that there was an initial increase and surge in inflation due to the spending, but you can see spending for goods on the left-hand side chart has really flattened over the last year, but goods inflation has continued to go up. And the main reason there is the supply bottlenecks and supply chain issues that we keep hearing about. Those are finally have been improving over the last few months, headed into the mid to late fall. but goods inflation continues to, the residue remains in place. What's more concerning is services inflation, which is a bit more sticky. And this is where consumer spending has rotated into and has really driven inflation higher. And so the concern here is that inflation will remain higher for longer. And that means the Federal Reserve will continue to try to escalate interest rates higher in order to slow down inflation, and that'll have very negative impacts for the housing market. And I'll come back to that point in a second. The other issue that the Federal Reserve is really concerned about is the labor market, which is red hot. The unemployment rate is 3.7%. About half of all states are running at record lows. Here on the left-hand side, I've plotted a little bit of a different kind of chart. Here I've plotted the number of job openings per unemployed person. It really shows how hot the labor market has been. You know, when we show the current unemployment rate is about 3.7%. That's about as low as it was in late 2019, very early 2020. So the labor market from an unemployment rate perspective is about the same. But when you look at the number of job openings currently relative to where it was in 2019, it's much higher. So we basically have a little bit of under 2 job openings for every unemployed person. And the data only goes back to 2000. JP Morgan has done some work that where they estimate this data set back to the 1960s, and it shows that over the last year and a half or so, we've had the highest levels of job openings to unemployment that we've ever seen. And the result of the red hot job market is much higher wage growth. On the right side, I've plotted wage growth by the various quartiles. So the first quartile is the lowest paying quartile. The fourth quartile is the highest paying. And you can see that generally speaking, those on the lower end of the wage continuum have had higher wage growth prior to the pandemic, but even more so during the pandemic. And so that's great news. However, the caveat to all this is that inflation is higher than any of those lines that you see on the right-hand side. So despite the fact that we've got a record hot labor market, and despite the fact that we're getting very strong wage growth, particularly for the people that need it the most, who are the lowest paid, they are still falling behind on inflation. And this is why the Federal Reserve is particularly concerned about the impacts of higher inflation on the consumer. And the Federal Reserve has been raising rates for most of this year. They control the short end of the curve. They do not control the long end of the curve. The long end of the curve is determined by supply demand factors for long-term bonds. However, there's a relationship between the two, and mortgage rates have surged in 22 at the fastest rate since the early 1980s. Today, we have the highest mortgage rates since 2002 for the latest data, which is actually not on the chart on your left. We just updated that in the last day or so. If we take a look, what's really interesting is if you look at the mortgage rate dispersion, which is on the right. Unfortunately, we only have data back to 2010, and the dispersion here is we look at the mortgage rates for those that are paying the highest mortgage rates in any particular week versus those that are paying the lowest mortgage rates in any particular week, and that dispersion is usually about 15 to 20 basis points. So, for example, if rates in any one week were 6%, this basically means that those that were paying the highest were paying 6.1, and those that were paying the lowest were paying 5.9. So about a 20 basis point spread. Today, that spread has risen to about 55 basis points. So this is a big deal. And one of the things we've been trying to emphasize in our public comments is it's become extremely, extremely important for consumers to shop, because they can save a lot of money if they go to several originators and compare rates, and they can save at least 30 to 40 basis points if they do that. When we take a look at affordability, due to the run up in interest rates, it's caused a severe decline in affordability. There are many different ways to measure affordability. The majority of affordability metrics show that affordability today is worse than where it was in the mid 2000s, and is one of the sort of we're at one of the worst levels of affordability over the last few decades. Most of those affordability indices do not factor in rent. So what we've done here is, with our purchase applications data, we've taken the purchase applications for first-time homebuyers who are purchasing a home, but are currently renting a single family home. And so we know the exact rent on the property that they're in now. And then we can estimate the mortgage payment on the property that they're in now. So this is down at the parcel level. We know the actual rent and we know the value of the property. And so we can estimate what their mortgage payment would be. And this ratio is the ratio of the mortgage payment relative to the actual rent for the home that they're in now. And so so any rise in the line indicates that affordability is declining. And if the line drops, then that means affordability is getting better. And so you can see that today, that from an affordability perspective, it's as bad as the mid 2000s, but not worse. Now that's still a bad picture, no doubt about it, but it's not worse. And the main reason here is just rents have been rising very rapidly. Sure, home prices have risen about 40% or so since the pandemic started, and mortgage rates are much higher. So that's made the monthly payment increase 60, 70% or so. However, we've seen a large increase in rents. And so I think at the margin, and this is, I think, the main reason that you see so many first-time homebuyers still in the market. If you look at the first-time homebuyer share today, it's running at about 50%. In the mid-2000s, it was running about a quarter. A lot of the demand that we're seeing in the market is still from first-time homebuyers, despite the fact that rates and home prices have increased so much. And the main reason is that rents have increased so much. And so I think many first-time homebuyers are just trying to get out and buy anything in order to curtail their carrying costs on their rentals, because they know with a mortgage that their payment will remain fixed for until they refinance at some point in the future. You know, they have the refinance option. However, their rent will continue to increase, and currently rents are or at least the past year have been rising at double digit rates. If we take a look at the result of the run up in mortgage rates on the home sales market, it's been drastic to say the least. Home sales have declined about 20% or so for the latest reading as of September, and more concerning is what's going to happen the next few months. Here I've plotted on the left hand side the pending home sales index from the National Association of Realtors, and there, if you take a look at the year-over-year change in pending sales, they're down 30%, so negative 30%. Actually, home sales are down about 20%. So this means that over the next couple months, we expect home sales to decline another 10%. When we take a look at on the right-hand side, our purchase applications data, there's been just a straight linear decline in 22. This chart here shows the percent change in applications in the year 22 by week relative to the 3-year pre-COVID average in 2017 to 2019. So the way you read this is in the early weeks of 22 of this year, demand for purchase homes was running about 20% above pre-pandemic levels. Today, it's down 30%. And the concern is, if you look at the last few weeks, the bottom has just fallen out of the market as rates have crossed above 7%. So I'm really concerned about home sales the next few months, and I expect them to weaken even more so. Here I've plotted the same purchase applications data. Each dot here reflects 1 week's worth of data, and it shows the level of purchase applications on the horizontal axis, on the x-axis on the bottom, and then on the left vertical axis, the y-axis, we've got the mortgage rate. So generally speaking, what happened during the 1990s, which are the gray dots and the green dots, and the early to mid 2000s, which are the light blue dots, there's been a general relationship is as rates fell, the demand for homes increases, right? That makes complete sense. But what's really interesting is if you look at between 2009 and 2019, after the Great Recession, we basically had a complete decline in demand, and it felt like they were a bit insensitive to rates. The market was so damaged. There was so much damage from the Great Recession that you sort of lost that pattern, that smoother pattern in the prior decades. The concern is that what's happened over the past year or so, and you can see the last data point, is that as rates have risen up to 1990s, it's not quite at 1990s levels. It's at sort of at the bottom end. but the demand, the amount of application activity is very low for the where we are at the 7% handle. In fact, the way you kind of sort of can think about this differently is if you sort of draw an imaginary horizontal line at 7%, and you can see that in the mid 2000s we had rates of 7% where demand was 2 to 3 times where it is today. So that just shows you how sensitive home buyers have gotten to the run up in rates, and they are much less able to handle a 7% rate today versus the 2000s or the 1990s. So that gives in sort of an overview of kind of the typical home buyer. What about investors? You keep hearing a lot about how investor activity is really driving up the market, and it's not in the data that we look at here. We are using parcel level data that's got about 150 million parcel coverage. So it's very robust in terms of the amount of coverage it's got for the market. And when we look at the investor share, generally speaking, during the last decade, it was slowly declining. You see those up and down movements; those are seasonal movements in investor activity. And then we had a minor tick up of about 2 percentage points. It was running in the sort of 23 to 24% range pre-COVID or so, and it ticked up to about 26% post-COVID, and it remains a little bit elevated, but there's not been a surge in investor activity at all. And in fact, if you look at cash shares on the on the right-hand side, we've had a similar 2 percentage point increase, but it's still well below where it was last decade or even the decade before during the boom bust of the mid 2000s. Here we have broken out that investor share that I just showed on the last slide, and I've broken them out into various categories. I've got 5 categories here of individual investors. These are just mom and pop investors who just own one property, small investors that own 2 to 9 properties, mid-sized investors which own in the green line, which are 10 to 99 properties, institutional investors. These are the investors that have deep Wall Street pocket money, and they are buying 100 or more properties in a year. That's the red line. And the I buyers, which I don't necessarily categorize as investors, but we sort of put them here for completeness sake. The reason I don't think of them as investors is they tend to be an intermediary. They sort of are like the CarMax of the car market. They will buy and purchase homes to provide liquidity for home buyers, but they're not buying and holding for a long period of time. And what's interesting about this chart is there's a lot of noise about institutional investors, which are the red line, and there's been a definite increase. They were under 1% or so pre-pandemic. They increased to about 2.5% or so, but they remain very low as a share of the market, especially compared to individual investors, which are by far the biggest category. When we zoom in on these smaller categories, so this is the same chart. It's just we've taken out the 2 biggest categories, and we've left in the 3 smallest categories: institutional investors, iBuyers, and mid-sized buyers. And you can see that institutional investors have risen. Their share of the market has risen. It was a little bit under 1%. It's risen to about 2.5, 3% or so. And so their size of the market has increased, but their share remains very low. We are actually doing a deep dive on institutional investors, and we'll be coming out with some research soon that illustrates that while nationally their share is low, they are very and highly concentrated in southeastern markets, and in a handful of southeastern markets, and even within those southeastern markets, and a handful of metros, and within those metros, and a handful of neighborhoods. So their investments are very fractal, and so in the markets they're in, they actually have a big impact. However, nationally, their impact remains very small. So, due to the run up in interest rates and the decline in a large decline in home sales, what does this mean for inventory? It means inventories have just soared. At least on the surface, it appears that way. So if we, on the left-hand side, I've plotted here the active listings inventory, the year-over-year change, and you can see during COVID how there was, the large increase in demand led to a substantial decline in inventory. However, the weakness over the last 10, 11 months or so has led to a large increase, or at least on the surface, what appears to be a large increase in inventory. However, if you look at the chart in the middle where we plot the level of home sales, you can see that inventory remains really low. The reason that the percent change looks high is it's coming off such a small base, but the level of inventory today is running at about 1.6 or 1.7 million. During the mid 2000s, it was running at about 2.2 or 2.3 million, and I would even argue that that was a low level of inventory and should have been higher than that. So we are about a million short in terms of the number of homes that should be on the market. So despite the very large decline in home sales, inventory remains low. And it's really interesting, despite the weakness in the market that we're seeing. If you look on the right chart here, we've plotted the number of homes that are under contract in under 3 days or less. And despite all the weakness in the market, that share remains elevated, which really tells you for homes that are in good neighborhoods, that are in kind of high quality neighborhoods, they're in high demand despite the overall macro weakness that we're seeing in the housing market. So overall, when we get a decline in demand and a run up in inventories, that means home prices will not only slow down but eventually decline. And on the left hand side, we've plotted the year over year change in home prices. They peaked at a little over 20%. They're now down to 11%, 11.8% on a year over year basis as of August. When we take a look at the month over month change, the picture looks more dramatic, and home prices are already declining 30 to 40 basis points a month the last couple months. But more concerning is the speed of the deceleration of home prices. Just in March, April, home prices were marching higher at 1.5 to 1.7% a month, which is very high in terms of the growth rate. Especially, you can see that clearly as it relates to 2017 and 2018, where in any typical month, home prices were rising 30 to 50 basis points. And so we go from a very hot market where home prices are rising 1.5% a month in the spring to now shrinking by 30 or 40 basis points. So the speed of that adjustment has been historic. And I've plotted a couple of charts here on it, and I want to focus on the right-hand chart here. And what we've done here is plot the change in home price growth from the first month that the Federal Reserve started to hike to the terminal month that the Federal Reserve stopped hiking. So there have been these episodes that you see on your screen in October of 93, January of 96, October 98, June 03, June 05, November 12, September 17, September of 2017, and January of 22, where the Federal Reserve began to raise interest rates in each of the prior cycles prior to the current one that we're still in. The cycle lasted 13 to 14 months. What's interesting is if you look at the first four cycles in the 90s and early 2000s, whenever the Federal Reserve raised interest rates, home prices actually accelerated. It didn't impact home prices at all. And the main reason is that the Federal Reserve was usually hiking because the economy was red hot and was generating a lot of job growth and income growth. And so it was basically kind of a reflection of a strong market. And so there was literally no impact on the housing market at all. However, since the mid 2000s, anytime the Federal Reserve has raised interest rates, it's had an impact on home prices. And you can see the most recent time period, this cycle that began in January, and we have here data through August, and on an annualized basis, the deceleration has swung by 23.7 percentage points, by far the fastest adjustment. Moreover, this is only 8 months in. The other bars that you see in your chart are generally 13 to 14 months in length. So and we're still going through the current cycle. So this number will get worse as the Federal Reserve continues to increase rates. So there's been a substantial impact. The bottom line is there's been a substantial and historic impact of the increase in interest rates on the housing market. What's particularly interesting is the relationship between supply and demand and home prices. Historically, we've used the month's supply as a sort of rough rule of thumb of where home prices would go for the next year. And here what we've plotted is the month supply for any particular month back the last couple of decades on the horizontal x-axis on the bottom versus the annualized 3-month change in home prices on the y-axis. And you've got this sort of, pretty strong linear relationship that any time that the month supply or inventory of supply rises, you get a deceleration or decline in home prices. Generally, when there are declines in home prices, we get inventory to sales ratios in the housing market or the month supply between 6 to 9 months. That's when home prices start to weaken. When we take a look at where we are today, we're still at 3 months, and yet home prices are already declining. And the main reason here is I think there's just so much inertia and momentum and negative sentiment around the rise in interest rates that it's blown apart fundamentals in the housing market. And so we're getting this weird, outlier tail events where you get, a decline in home prices, even though there's still very little supply on the market, which is a very unusual time. And by the way, the same exact thing is happening in the car market. The inventory of cars for sale today are about a third of where they were pre-COVID, yet car prices are declining. And again, it's just a reflection of the massive run up in interest rates and the decline in affordability that's happened just so quickly. So what's been the impact on home prices? We've already talked about it nationally. Regionally, it's really interesting. The areas that have been hit the hardest have been the West Coast, particularly San Francisco and Seattle. And I think there's several reasons there. Is first, we've had large outflow of migration out of the West Coast, and I'll have a slide on that in a minute. But moreover, for San Francisco and Seattle, we've seen substantial declines in the tech market. And so I think you get a double whammy there in these markets. Lots of people moving out, interest rates going up, stock market going down, and the NASDAQ has gone down a lot. You can see that there's been weakness, sort of throughout the country, but there are some exceptions, some kind of in the upper Midwest and the Southeast, and the main reason there is really migration more than anything else. And let me move to that next. So what we've done here with our data is use our purchase applications data in sort of a creative way, where we take a look at for each purchase applicant, we take a look at where their current address is today and where they are applying to. We are only looking at owner-occupied buyers. We're not looking at investors or second home buyers. And here, what you're seeing on your screen is the net migration into and out of these markets. So for example, the red line is the net migration into the 25 largest markets. And so and that number has been negative the whole time. And what that means is that there are thousands of people moving into these markets, but then more that are moving out. And so the net has been negative. And what's really interesting about this is it's pro-cyclical with the housing market. So as the housing market became very unaffordable, particularly on the coast, more and more people left these larger markets. And then when the market crashed in the late 2010s and in the late 2000s and early 2010s, less people left these markets. What's interesting is that phenomenon began to get worse again as these markets really became expensive pre-COVID. And then once COVID hit and home prices rose 40% across most of the U.S., you had a lot of people move out. Of course, COVID heavily drove this with people being able to work remotely or in a hybrid environment. And so here you've had a large and historic outflow out of the 25 largest markets, and not only out of the 25 largest, but even the markets that are not in the top 25, but have a population of over 1 million, which is the light blue line. You've seen an outflow out of these markets. Where are they going? Pretty much anywhere else, really. If you look at any market that's below 1 million, they're gaining people, and they're gaining a lot of people. And this is why home prices on the last chart that I showed remain positive in the Southeast and in some of the upper Midwest. Here's another sort of chart that sort of illustrate this. And here I've plotted sort of 10 different charts, 2 charts for 10 different metros. On the left-hand side, I've plotted net migration for New York, LA, San Francisco, DC, Boston, Miami. So it's a subset of the red line that was in the prior chart. And you can see that the dramatic fall off where they've lost over 100,000, and it's barely. What's really fascinating about this is it's not gotten any better. It's barely gotten better at all. And this data is as of September. And so the outflow out of these markets continues unabated. in the fall of 22. What's really interesting is what's happening in sort of the hot hit markets. So, your Denvers, your Salt Lake City, Austin, Texas, not Nashville, and Raleigh. They had positive net migration. People were moving there, but they became victims of their own success. So even prior to COVID in 2020, they started to lose folks. It was a small number, but they started to lose in terms of from a migration perspective, because they became too expensive for people that were moving there. And then during COVID, the bottom just fell out of these markets. So even some of these markets that you would think would have blossomed during the pandemic are actually losing people because they've gotten so expensive. So if they're avoiding the West Coast markets and they're now increasingly avoiding sort of some of these recent hot markets, where are they going? A lot of very small markets in coastal Florida, outside of Miami, basically anywhere outside of Miami. So that's the red line here. So very strong and positive in migration. Many interior California markets. So a lot of folks are moving out of, so for example, Riverside is the #1 inbound migration market in the U.S. And where are all these people coming to Riverside? Where are they coming from? They're coming from LA. And so there's been a drive from the coastal parts of California into the Central Valley. So it's not just Riverside, but Stockton, Modesto, markets like that have seen a strong inflow of migrants. Another is the southern metros, and this showed up very strongly on the home price map. A lot of these secondary and tertiary markets in the South. So these are very small markets like a Chattanooga or Knoxville, Tennessee, which are fairly small but rapidly growing. They were growing before the pandemic, but they have really zoomed in the last couple of years. And then lastly, the mountain region metros. So these are markets like a Boise, which Coeur d'Alene, Idaho, which became very hot and active. They were already becoming popular pre-COVID, but really boomed. But then home prices ran up so fast in Boise. Home prices were up 40% in just 1 year, which just sort of just tells you how crazy this market has been. And it just became too expensive for people to move there. So they have actually slowed down quite a bit from a migration perspective. And no surprise that home price growth has slowed down as a result. So to conclude, economic growth is slowing due to the increase in fiscal interest rate and inflationary headwinds. The risk of recession is rapidly rising due to the Federal Reserve's commitment to slow down the rate of inflation. The Federal Reserve is starting to get a little bit wobbly on that commitment, but they still it feels like in real time they still want to keep raising rates in order to slow down inflation. Due to the Fed's policy, home purchase demand has collapsed due to the 20-year high in mortgage rates, and demand there was sort of a straight linear decline in demand up until 7%. When rates cross 7%, it just feels like the bottom has fallen out of the market. And this has been a very recent event in the last 3 or 4 weeks, so mainly in October. And then due to the collapse in purchase demand, supply for sale, the inventory for sale has risen, but it still remains low relative to pre-COVID. However, despite the fact that inventory is low, home prices are now declining at the fastest rate ever. I don't think this is not a repeat of what happened in the mid 2000s. I think the adjustment process has just gotten much faster. The book of business is very, very clean. The FICOs are high, lots of cushion for these borrowers. However, the adjustment is going to be painful in the short term for home buyers, really more so than home owners. And then a couple kind of bigger picture comments. The fundamental problem in the housing market is that the supply-demand imbalance over the last couple of decades has led to a market that's chronically overvalued, become a lot more volatile and sensitive to mortgage rates. So I'm concerned that the market is beginning to exhibit consistent boom-bust type of behavior, whereas it really prior to the mid 2000s, it really didn't do that. It's really behaving more like the stock market, the housing market is. And then lastly, and this is a bit of an optimistic, there's sort of an optimistic, but also a less optimistic take, which is that the overvaluation of expensive markets combined with COVID has led to a large out-migration out of these markets and is driving growth in more affordable markets, which in one sense is good for these markets. And it's an opportunity for many home buyers to withstand the run-up in rates. However, it means there's a shift in the spatial risk gradient to interior markets that have historically been affordable. And it could mean, and we're already seeing it in a market like Boise, that interior markets that in the past have been more stable are now becoming more volatile. And with that, this concludes our session of the Economic and Housing Outlook. Thank you for your time. Cheers.